This is the most dangerous market ever. Look at valuations, have never been this extreme. If you're in these target date funds, these buy and hold funds, you are going to get slaughtered if you don't take measures in your own hands to just get ready to protect yourself.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 6th through January 13th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10-ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this widely followed returning guest. Michael Pento, the founder of Pento Portfolio Strategies, is an active money manager. He joins us again this Thursday, January 9th, 2025. Michael, thank you for coming back on Liberty and Finance.
Always good to see you, Dunnigan.
We enjoy not only your chats here with us and for our viewers and subscribers, but also I get your publications that you put out, which are very helpful to keep us pointed in the right direction. I like to joke and call it the midweek sanity check. I think you call it the midweek reality check. So thank you for that.
I have to change the name. I like yours better.
There's precious little sanity to be had in this world at the moment, but you're here in our corner, and on behalf of our viewers and subscribers, I thank you for that. We have some questions that have been submitted ahead of your arrival here, and one of them said it's not a question, it's just a comment. He's just looking forward to your perspectives on where we're at right now and where the markets are going. There's a question that comes up quite often that is about, you keep looking at forward-looking indicators, which is much better than what the Fed does, which is looking at trailing indicators, so that they're looking in the rearview mirror and you're looking out the windshield, which is great. A lot of our viewers are concerned about the volatility and choppiness, extremes, and in the both the equity markets and the bond markets. Can you first start with your current view of both the stock market health and the bond market, and then we're going to get into some specific questions that were sent in for you.
So what do you mean there's not sanity? I mean, don't you know fart coin deserves to be like the entire market cap of like France or the British stock market? I mean, come on. This is the most insane time. I've been licensed now for 34 years. I think if you look at my neck, I just noticed that I'm showing my age a little bit here. So I'm 61 years old. I mean, there's a long time. I never remember. Not that I don't remember. It has never happened before that you had a triumvirate of bubbles in stocks, bonds, and equities. But bubbles are, they can exist for a long time. I mean, people were talking about bubbles in 96 and 97. Alan Greenspan says, irrational exuberance. They can continue for years, but then they always burst and they always mean revert. But this time you have to mean revert home prices, equity prices, and bond prices. Bond prices really, I mean, if you look at things like high yield bonds, the spread to treasuries is just about as tight as it's ever been in history. And then you have things like collateralized loan obligations, and you've got new things like private credit, which, so if you can't get a loan, if a business can't get a loan from the bank and they're highly leveraged and they can't even float debt in the corporate bond market, they just, go to like the shadow banking system and say, hey, here's some debt, finance it at a very low interest rate. And you can't get out of it. You don't price these. There's no pricing mechanisms for these bonds. It's private. So that means you're locked in. There's no liquidity. I mean, this is a big, big problem that we have once the recession hits, and there will be another recession. The yield curve, by the way, just normalized in December. That's not too long ago. And it usually takes around 3 to 6 months after the yield curve normalizes before you see a recession. And we had the longest inversion of the yield curve in history, and it was the second deepest inversion in history. The spread between the 2 and 10-year note. So I don't throw out my theory that we're in for a lot of trouble. I invest money for clients. We had a positive return in 2024. So it's not like I'm sitting here shorting the market. I'm just warning people. I'm not a Cassandra. I'm just warning people that this is the most dangerous market ever. Look at valuations, have never been this extreme. If you look at things like price to sales or total market cap of equities to GDP, or if you look at earnings yields, so the risk premium, earnings yields minus treasuries, it's zero, if not negative. So what I'm doing right now is I'm only slightly long the market. I have a slightly net long position, about 15% long the market with hedges. In the portfolio, I have a tremendous amount of bonds on the short end of the yield curve. I think whatever's left in this bull market is not really worth the risk of being overly long in this. First of all, if you were in the 60-40 portfolio, think about 2022. So 60% stocks, 40% bonds. And that, by the way, that reverses as you get older, where you could have, say, 30% stocks and 70% bonds. If you look at long duration bonds, they are down 50% since 2020, 50. So your return on a bond fund that's out along the yield curve, you've lost half of your money, not in Bitcoin, not in Fartcoin, not in some pink sheet stock that doesn't trade. In U.S. Treasury bonds, you lost half of the value. So I think 2025 could look a lot like 2022 when you see these bubbles burst. For the timing, I rely on my model that I created. It's not time yet. It's not going to happen, on Friday, I don't think. But it's definitely something that's going to happen soon. And when it happens, it could bring down both bonds and equities concurrently. Along with real estate, it could be very, very dangerous for the 60-40 buy and hold portfolio. So I would maintain an extreme flexibility and have a robust model, an algorithm that lets you know when to get out of harm's way, when to go into short-term treasuries, when to go into cash, when to go into the dollar, which, by the way, the dollar's been working spectacularly if you're long the dollar. So that even could get even worse. As far as the appreciation of the dollar, and you must be able to short the market adroitly. And that's my plan.
Hey, I think you've laid out the case for being an active money manager or having an active money manager. We'll talk about that later on. But I wanted to underscore several of the points that you made about the bond behavior, the equity behavior, and the importance of having dry powder. We've seen 6-to-1 insider selling of the major, even among the Magnificent Seven, or the whatever you want to call it, the Fantastic Five, or whoever it's holding up the market. Buffett having a record cash reserve now that he's built up, and also just the move of those who seem to be at the top of the food chain into positions of relative safety, anticipating that, basically acknowledging the overvaluation, the bubble of the market. Any specific observations or things that you're watching there in terms of what insiders or the big fish are doing in this environment?
Well, there's a letter called, I think it's the Kobayashi letter, that put out a very good stat. The leveraged long positions in these leveraged ETFs are 100 times greater than short ETFs. So that's why there's no margin, but there's a lot less margin debt on the NYSE. You don't have to have a prime broker and borrow in a type 3 margin account, short them, and you have to come up with money and pay interest and all this. You have to pay the dividend. You could just buy a leveraged ETF if you want juice in the market. So it's belying the fact that there's a lot of leverage out there, and it's all in these leveraged ETFs. And 100 times more than you find in the inverse ETFs. So that means I don't care what sentiment says, the fear of missing out, the FOMO, And the speculation in this stock market has never been greater in the history of my 34 years of being a licensed professional. And that means it's just a tremendous amount of downside. And, you think people say, I hear it over and over again, Donningham. They say on the mainstream financial media, well, don't worry about it because the government and the Fed has your back. If we have a downturn in the economy, or if we have, a hiccup in the stock market, or home prices start to fall and bank assets start to come under pressure, we'll just cut interest rates. Well, the funny thing is, the Fed is in an interest rate cutting regime. You know that, right? They've cut interest rates by 100 basis points, and every single part of the yield curve has seen bond prices fall and yields go higher. Every single part. And mortgage rates are up 100 basis points, 1%, since the Fed decided it was a very necessary move to cut interest rates, because they understand. Don't listen to me. Listen to Jerome Powell. He gets it. That's the reason why he's cutting interest rates. He's cutting interest rates because the Treasury cannot afford interest, $1 trillion plus interest on the national debt. And they see bank assets are coming under extreme duress here. And so he's trying to get the borrowing costs of the consumer and for corporations down, but it's the exact opposite that's happening. I don't care what he's doing. Borrowing costs are elevated. Interest rates are rising. The interest rates in the United States are the highest in, I think, 18 years. 18 years. And it's not just the United States. In the United Kingdom, they're the highest since 1998. So we have a global revolution in the corporate and sovereign bond markets. That's just the nascent, that's just the beginnings of these tremors. And when you have rates that are rising on a record amount of debt, we have a record amount of total non-financial debt as a percentage of GDP is at an all-time record. So there's a tremendous amount of debt out there. And when you see rates rising on that debt, and the debt was used to engender these asset bubbles that I just talked about, stocks, bonds, and real estate, you have the most dangerous cocktail we've ever seen. So please, I hope your audience is in the millions. And but if even if it's an audience of like 2, I know you have a very high audience. I'm not deriding your audience. Your audience is growing and it's very vibrant. I'm saying I wish that you had, I could tell everybody, because I've been thrown off the mainstream financial media. Everybody needs to know that if you're in these target date funds, these buy and hold funds, you are going to get slaughtered if you don't take measures in your own hands to just get ready to protect yourself. Now, I'm looking at financial conditions, and I'm looking at credit spreads myopically to let me know, not when I think it's time to worry, not when I had a bad dream last night, not when somebody on CNBS says, hey, you know what? I think the 200-day moving average is in jeopardy here, but it's going to be support. I need to know the arcane components of the market that I look at in my 20-component model that let me know when the big boys on Wall Street, the insiders that know what's happening with the CLOs and the private credit, when they know that their assets are deteriorating and the cash flows are going dry, when they know before anybody else will come on CNBS and tell you, they start selling. They start buying insurance. They start buying credit default swaps. And that sends the financial conditions index higher. And you'll see people selling junk bonds and heading into treasuries. The insiders, the people that know, that's where my fingers are on the pulse of. And I will take actions because I think that the danger in this market is going to be like we've never seen before. And I'm not I'm not trying to use hyperbole here. The reason why I say that is because we do have record asset prices. That's a fact. But what I'm most worried about, and by the way, before I make the statement, we've had bubbles in real estate before. And the real estate prices dropped by 33% nationwide. The Fed cut interest rates to 0 and fixed the problem eventually, right? The stock market has fell apart in the global financial crisis. It fell apart in 2000. From 2002, it lost 50%, the S&P. But the Fed was able to come to the rescue eventually. Not that you losing 50% for a few years isn't a problem. It's a problem. But the Fed was able to fix everything by what? By lowering interest rates and printing a bunch of money. It's not a guarantee, but there's a very significant risk. And it was in my model. I predicted it. It's happening. Doesn't mean it's going to continue to happen. It's not guaranteed to happen. But when the Fed lowers interest rates next time and the economy experiences a problem, the insolvency condition of treasuries and the fact that inflation is still salient in the minds of investors. We haven't returned to 2%. We're no longer growing at 9% inflation. We're down to 3%. Congratulations, but you've already bankrupted the middle class. But it's a combination of inflation and insolvency, because I think deficits can go to $6 trillion. The annual deficit could be $6 trillion in the next recession, just based on the last 3 recessions and the percent increase in the deficit. $6 trillion. You could have bond yields spike even in a recession. And even if they don't spike, they might not come down, especially on the long end of the curve, the way they usually do. I mean, the Fed controls the short end of the bond market. I'm not saying that they can't lower the Fed funds rate to 0. They'll be late to the game. They'll be reticent to do it because they know what happens. They already know what the inflation is going to come, and they don't want that. But they'll eventually have to do that because, if the choice is inflation or a depression, they'll always, every central banker, not just the Fed, they'll always choose inflation. It's just much easier to lie about and hide. But when you talk about the total, bankruptcy of the financial system vis-a-vis, intractable inflation, they'll always choose intractable inflation. And that, I believe, will cause yields to spike to levels even higher than they were in 1980.
You mentioned the Kobayashi letter. They just put out an hour ago some tweets on X. One says, 2 days ago, the Institute of Supply Management, ISM, purchased the prices paid index is now at the highest level since February 2023. It's considered one of the primary leading indicators of core price index inflation. The Fed's worst nightmare has begun. Prices paid by purchasing managers are at a 22-month high. The last time ISM prices paid were this high, inflation in the U.S. was at 6+% in February 2023. That was one of the things you talked about, intractable inflation.
Exactly. And look at the bond market. Look at the trading in the bond market. The bond market is not blind to what's actually happening.
Yeah, that's the other thing I was going to mention. But Bloomberg came out just two days ago with a Treasury auction draws the highest yield since 2007 in bond sell-off. And yet the two economists or money managers that they interview in here both say, oh, that just shows how robustly strong the economy is.
So there's private. So you have to look at private source data too, not just the Labor Department. So Challenger, Gray, and Christmas just said, they just calculated that we had the lowest hiring plans announced since 15 years. The lowest hiring plans in 2024. I think it was like 769,000 net new hiring plans in 15 years. So how robust really is the labor market? Now, the unemployment rate is quiescent still. It's still way below the average. But that begs the question: if the stock market is in a massive bubble, you can't make an argument for cutting interest rates because the stock market's in pain, and you can't say, well, home prices are dirt cheap. We have to get the home prices up a little bit, and the unemployment rate is quiescent. What is the real reason why the Fed is in a rate cutting cycle? I mean, what the Fed has appropriately said that they instead of cutting the rates 3 times in 2025 this year, they're going to cut like maybe once or twice. So they're going in the right direction. But why are they cutting rates at all, given what you just indicated? So the inflation target has been missed to the upside for like almost 40 months. I'm like 40 months now, almost 40 months. 40, not 40. How in the world can you miss your target on inflation to the upside and be cutting interest rates, especially when that target is being missed more in the opposite direction? I mean, the rate of change is increasing. Second derivative. So I don't understand what the Fed is doing, other than the fact you have to agree with me. They're worried about keeping interest rates on debt service down, so they're lowering all of our debt is financed on the short end of the yield curve, T-bills. So that's good news, I guess, if you can say, well, it's good news. They could just cut interest rates. But you're also rolling over that debt all of the time. So if the Fed ever has to, assent to the notion that, hey, inflation is a big problem, we're going to have to raise interest rates, you're rolling over that debt, which is a massive debt. You're talking about with $34 trillion, $35 trillion, rolled over every single year. That's the direction we're going. I don't know why we didn't lock up long-term rates. When the 30-year bond was like 1%, why didn't we just issue 30-year bonds? But the geniuses at the Treasury Department said, hey, we need to finance all this debt on the short end. So we have like a floating adjustable rate mortgage on our debt. It's very, very dangerous. It's okay. So Mr. Pento, I guess the Fed will just keep interest rates at zero and we won't have a problem. Well, I mean, you talk about hyperinflation. That's what it's not that this country is immune from the effects of economics. The machinations of economics, the laws of economics, don't change and dry up or stall out on the shores of the United States. We have never, in my history, and it's a long history I indicated, thought that the Federal Reserve would print trillions upon trillions of dollars in a matter of a few years. But just rewind the clock back to 2007. The Fed's balance sheet was $700 billion in 2007. And really just a few years later, we're not talking about a long time, right? We're talking about maybe 17 years, 18 years, 17 years. We went to $9 trillion in the Fed's balance sheet. They monetized, created out of thin air by fiat, by decree, credit, which is the same. It's part of the high-powered money. It's the same as printing money. It's Fed credit. Fed credit can be used. It's the money that banks use to buy bonds, but that can be used and converted to cash. They created trillions, over $8 trillion. That was unthinkable in the 90s and in the early part of the 2000s. Never. But we did it here. And so when people say, well, we'll never have hyperinflation because of let me just take that on for a second. We'll never have a problem in the bond market. I hear it today. We'll never have a problem in the bond market because the U.S. dollar is the world's reserve currency and the U.S. bond market is the most liquid and blah, 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 blah. But wait a second. Was the U.S. dollar the world's reserve currency in 1980? Yes, check. Was the U.S. bond market the most liquid bond market in the world, in the planet in 1980? Yes. But inflation caused the Fed funds rate to go to 20%. Volcker had to take the Fed funds rate to 20% because the Treasury, the benchmark Treasury went to 16%. So why can't it? You could have all those things are true. The bond market is the most liquid and deepest in the world, and the dollar is the world's reserve currency. But interest rates have to rise to represent inflation, and that is where I think we're going. I think we're going into intractable stagflation after we see this next iteration of recession, which I think is going to happen in 2025.
I know we're short on time. We'll just try to hit one or two viewers' questions that have been submitted ahead of your arrival. A lot of our viewers are concerned about the fragility of the current edifice, the way you've described it, everything you just described. Indy 5542 says, what is your strategy for your clients' funds right before the spit hits the fan and immediately after?
Okay, so I mean, it's a very generic question, and I have to know the macroeconomic environment. But going into this interview, as I indicated already, we have a slightly net long position. But going into a recession, we would be in what I call sector one, which would be bond and bond proxies. And you have to know what part of the yield curve. For example, bonds were down 20% in 2024, but if you owned 1 to 3 year treasuries, they were unchanged. Bond price. I'm talking about bond prices. So you kept all of that yield. But if you went out along the yield curve, you're down 50% in the last 5 years, as I mentioned. So you wiped out, most of your gains that you made in the stock market over the last couple of years, especially if your bond sleeve of the portfolio was greater than your stock, your equity portion. So I'd be sector one, which is bond and bond proxies. You could have a little bit of gold there, but you have to worry about a liquidity crisis because gold will be sold in a liquidity crisis and you will be short the market. I think there's a tremendous amount of money to be made shorting the stock market. As I said, I think the Fed will be late to the game, and they're more impotent than ever before because they can't control the long end of the yield curve so easily. I mean, they can assent to buying every single bond issue like they do in Japan. But if you want to talk, we could turn the United States into Japan, which has in dollar terms the same GDP as they had in 1989. And the stock market is still down from where it was in 1989. So if we want to be Japan, we can be Japan. But first, you're going to lose, half of the market value of equities. So they can assent to do that, but you're talking about intractable stagflation. Then after, this is the second part of your question, I think we're going to have to be positioned for stagflation, which is energy, base metals, precious metals, shorting long-term bonds. That is what I will do. For me and my clients, my money is where my clients' money is. Same strategy.
We have one more question here from Jeremy Turner, 8682. With the current state of the housing market, is there any way that anyone can take advantage of the delinquencies in the market, specifically FHA mortgages? Is there anything that you're doing specifically to take advantage of this? This extend and pretend can only go on so long, and with the rising bonds across the globe, it appears as though the house of cards is starting to encounter some stiff headwinds.
Well, there's two things you could do. Well, number one is I have multiple homes, so I'm selling one of my homes. I'm in the process of doing that. In fact, I'll probably sign the listing agreement this week. It's one of the things I'm doing, putting my money where my mouth is. The other thing is I think you could short bank stocks because the assets they hold in CMBS and MBS will just devolve in value. I mean, they'll just plunge. And banks have had a massive run up because everybody's talking about, well, the economies are going to be great in 2025. So people have been buying banks, steepness of the yield curve, blah, blah, blah. So and not now, I wouldn't do it now. I would not short banks now. I'm saying after you see the whites of the eyes of a recession become manifest, my model is built to do that. That is when you would short bank stocks.
Speaking of your model, can you let people know how they can take advantage of you actively managing their funds if they so choose?
So there's a website, pentoport.com. I have a midweek reality check there. You can get my 36,000 foot view for $50 a year. And if you want me to specifically manage your money, you need $100,000. You need to qualify for the portfolio and you need to be a U.S. citizen. And you can use the contact page to send me an email and someone will get back to you. The most important thing I can leave you with, Dunnigan, and your audience is please don't fall asleep. Don't fall victim to this. Fed's got you back. Government's got you back. There's never going to be a problem in the stock market again. This is the wrong time. This is just, no matter, even if I'm wrong about the recession this year, and I could be, this is the wrong time to start going leverage long exposure in the stock market. I think there's just the odds of you're making significant money in the stock market above what you can get in a safe U.S. Treasury on the short end of the yield curve are very, very low.
We've been speaking with Michael Pento, active money manager and a forward-looking, voice on the hill calling to us to pay attention, stay awake, and don't fall asleep in this environment. Unfortunately, that's not, as you pointed out earlier, that's not what millions and millions and millions of people are hearing from their retail financial advisors and the mainstream financial press, just saying, all is well, strong economy, good employment, Fed's got your back, carry on. not what we were expecting in 2025. And we'll be keeping our eyes open, and you're a part of that. Thank you for being here with us. And folks, if you don't want to miss a single episode with Michael or any of our other guests, make sure that you're on our free mailing list at libertyandfinance.com. That's libertyandfinance.com. Put in your email address, click submit, confirm on the confirming email. You won't miss a single episode with Michael or any of our guests. Michael, thank you for joining us here again on Liberty and Finance.
My pleasure, Donnie.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 6th through January 13th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10-ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.